Have you ever looked at your mutual fund portfolio and wondered if the companies you're investing in actually align with your personal values? We talk endlessly about returns, risk, and compound interest. But what if your wealth is growing by funding industries you fundamentally oppose? Today, we explore exactly how the growing Indian stock market solves this exact modern dilemma. For decades, passively investing in the Indian stock market often meant leaving your personal beliefs at the door. But a truly massive shift is happening right now. Investors are demanding options that respect their cultural and religious boundaries without sacrificing financial growth. To meet this demand, the two biggest exchanges in India, the NSE and the BSE, have engineered specialized exclusion-based indices. But here's the catch. While they both claim to offer ethical investing, their underlying rules lead to portfolios that behave like complete opposites. Let us unpack exactly what is going on here. Here's where it gets interesting. The two heavyweights in this space are the newly launched BSE Saatvik 100 and the much older Nifty50 Shariah Index. Their foundational philosophies are completely different. The BSE Saatvik 100 is built on traditional Indian principles. It focuses on non-violence, compassion, and keeping away from toxic or addictive products. On the flip side, the Nifty50 Shariah Index is strictly governed by Islamic finance principles. This means it restricts businesses involved in prohibited activities, but more importantly, it strictly prohibits earning interest income and holding excessive debt. They are both exclusion-based, meaning they filter out the bad rather than picking the good. But their rule books are miles apart. Let us look at where they actually get their stocks from. The Saatvik 100 goes shopping in the BSE 500. It filters through those 500 companies to select exactly 100 businesses that meet its criteria. The Nifty50 Shariah, however, only looks at the Nifty 50. But here's the kicker. Because of its strict rules, as of late May 2026, only 17 companies from the Nifty 50 actually made the cut. So it's not a 50-stock portfolio, it's just 17 Sharia-compliant mega-cap stocks. Let us break this down with real business activities. The Saatvik screening automatically kicks out companies involved in alcohol, tobacco, gambling, weapons, and any business that harms living beings. The Sharia screening goes even further. It also excludes alcohol, tobacco, and gambling, but adds pork, narcotics, non-compliant entertainment, and crucially, conventional finance. Because of this single rule against conventional finance, banks absolutely dominate the Saatvik 100. But you won't find a single conventional bank in the Nifty50 Shariah Index. But most people stop here, and that's the mistake. The Nifty50 Shariah Index doesn't just look at what a business sells, it looks closely at the balance sheet. To be Sharia compliant, a company's interest-bearing debt cannot cross 25% of its total assets. Its interest income cannot exceed 3% of its total income, and its cash and receivables cannot be more than 90% of total assets. The Saatvik framework, on the other hand, is purely a business activity screen. It doesn't disclose any strict financial limits on debt or interest. Think of it this way. Because the Saatvik Index allows banks, financial services make up a massive 37.5% of the entire index. In fact, just 5 conventional banks, HDFC, ICICI, SBI, Axis, and Kotak, account for more than 26% of the total weight. This means the Saatvik 100 is highly exposed to credit cycles and interest rate changes by the Reserve Bank of India. Meanwhile, the Nifty50 Shariah Index has literally 0% allocation to conventional banking. Here's what the data actually shows about their sector balance. The Saatvik 100 relies heavily on financial services, energy, and consumer discretionary sectors. Energy alone is 11%. Now look at the Nifty50 Shariah Index. With banks out of the picture, information technology takes up a massive 36.5%. Healthcare sits at nearly 18%, and fast-moving consumer goods take up almost 16%. Energy is barely 4%. They are almost mirror opposites of each other. And this is the part most investors overlook: concentration risk. In the Saatvik 100, the top 5 companies make up about 33% of the total index. Those are HDFC, ICICI, Reliance Industries, Bharti Airtel, and Larsen & Toubro.
But look at the Shariah Index. Because it only holds 17 stocks, the top 5 alone make up more than 50% of the entire portfolio. Infosys sits at a staggering 17%. Tata Consultancy Services, Hindustan Unilever, Sun Pharma and Hindalco round out the rest. That's a very heavy bet on a very small group of companies. Both indices use a free float market capitalization method to assign weights to these companies. But to manage that heavy concentration, the Nifty50 Shariah explicitly caps any single stock at 33% and ensures the top 3 companies combined do not exceed 62%. The Saatvik 100 doesn't have these formal caps, simply because spreading the money across 100 stocks naturally keeps individual weights much lower. The markets change constantly, so how are these indices monitored? The Saatvik 100 takes a traditional approach. The BSE reviews and reconstitutes it twice a year, in June and December. The Nifty50 Shariah Index is radically different. It's screened every single month by an external advisory firm under the oversight of a Shariah board. If a company suddenly takes on too much debt, it can be removed swiftly, making the portfolio highly dynamic. Finally, let's talk about their track record. The BSE Saatvik 100 is brand new, launched on the 17th of June 2026. All its historical returns, like the 11% annualized return over 5 years, are purely back-tested data. As of now, there is no dedicated index fund or exchange-traded fund tracking it. The Nifty50 Shariah Index, however, is live from February 2008. It has a real 5-year annualized return of roughly 4.9%. It's tracked by the Nippon India ETF, though interestingly, the fund house states the ETF product itself is not certified as Shariah compliant. What this means is that values-based investing is never just about ethics. It's fundamentally about portfolio construction and risk management. When you apply a religious or philosophical filter to your money, you're forcibly altering your exposure to the broader Indian economy. Historically, what tends to happen when you remove banks, like in the Shariah Index, is that you miss out on the primary growth engine of a developing economy. India runs on credit. By excluding financial services, you're essentially swapping interest rate risk for severe sector concentration risk, specifically in IT and pharmaceuticals. The insight here is that neither index is inherently better or worse. They just serve entirely different masters. If you lean towards the Saatvik index in the future, you must understand that you're buying a heavily financialized portfolio. If banks struggle with bad loans, your portfolio will feel the pain immediately. If you choose the Shariah route, your returns are going to heavily depend on global tech spending and healthcare trends, because that's what dominates the remaining compliant universe. The Shariah Index has very few constituents. When an index only has 17 stocks, any disruption in just 1 or 2 of those companies will cause major swings in your overall wealth. The Saatvik Index provides a much wider cushion with 100 companies. The reality of the stock market is that every exclusion narrows your opportunity set. That's a perfectly valid choice, but it requires you to be twice as diligent about the remaining stocks in your basket. Everything we have covered today is purely for learning. Your financial decisions should always be based on your own research and, if needed, guidance from a qualified advisor. Don't just buy a mutual fund index because the name sounds good. You must always look under the hood. If you found this breakdown helpful, please subscribe to the channel. Drop a comment below if you have any questions about these 2 indices, and share this with someone who's trying to align their wealth with their values. This is Ishwar from Paisa Forever, signing off.